Congratulations! You graduated. This is a momentous occasion, a milestone that marks the beginning of a new chapter in your life. This is a huge accomplishment. You've worked hard, and now it's time to celebrate your success. Now, it's time to think about your future. What lies ahead? What are your dreams and aspirations? A big part of that is financial security. It's essential to start planning now to ensure a stable and prosperous future. That's where investing comes in. Investing might sound scary, especially if you're new to it. You might think it's only for rich people, but that's not true. Investing is a tool that anyone can use to grow their wealth. Investing is for everyone, especially young people like you. The earlier you start, the more time your money has to grow. The sooner you start, the better. Even small amounts can grow significantly over time. Think of investing as planting a tree. It requires patience and care, but the rewards are worth it. The best time to plant a tree was 20 years ago. The second best time is now. The second best time is now. The same goes for investing. Don't wait, start today. The same goes for investing. Don't wait, start today. Begin with what you have, and let your investments grow over time. This guide will help you understand the basics of investing. We'll break down complex concepts into easy-to-understand steps. We'll cover everything you need to know to get started, from understanding different types of investments to learning how to manage risk. Let's build a bright financial future together. With the right knowledge and tools, you can achieve financial independence and success. Imagine a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow and gets bigger and bigger. That's compound interest. Compound interest is the interest you earn on your interest. It's like free money. The earlier you start investing, the more time your money has to grow exponentially. Let's say you invest $1,000 today at a 7% annual return. In 10 years, you'll have almost $2,000. That's the power of compound interest. Time is your best friend when it comes to investing. The sooner you start, the more you benefit from this magical growth. Before you start investing, it's crucial to have an emergency fund. Think of it as your financial safety net. An emergency fund is money set aside for unexpected events. This could be anything from a medical bill to a car repair. Having an emergency fund gives you peace of mind. You won't have to go into debt or sell your investments if something unexpected happens. Aim to save 3 to 6 months worth of living expenses in your emergency fund. Keep this money in a safe and accessible account like a high-yield savings account. Once you have a solid emergency fund, you can start investing with confidence. Now let's talk about different investment options. There are many ways to invest your money, each with its own risks and rewards. The key is to find investments that align with your goals, risk tolerance, and time horizon. Don't worry, we'll break it down in simple terms. Two common investment options are stocks and bonds. Stocks represent ownership in a company, while bonds are like loans you give to governments or corporations. Other options include ETFs and mutual funds, which are baskets of stocks or bonds. These offer instant diversification, which we'll discuss later. Section 5. Stocks. Owning a piece of the pie. Investing in stocks can be one of the most rewarding ways to grow your wealth over time. When you buy a stock, you're buying a small piece of ownership in a company. This means you become a shareholder, and you have a claim on part of the company's assets and earnings. If the company does well, its stock price goes up, and your investment grows. This growth can come from the company increasing its profits, expanding its market share, or innovating new products and services. Stocks offer the potential for high returns over the long term. Historically, the stock market has provided higher returns compared to other types of investments, such as bonds or savings accounts. However, they also come with higher risks compared to bonds. The stock market can be volatile, and prices can fluctuate widely in the short term. There are different types of stocks, such as large cap stocks, which are large companies with a market capitalization of over $10 billion. These companies are usually well established and have a stable financial history, and small cap stocks, which are smaller companies with a market capitalization of less than $2 billion. These companies can offer significant growth potential but also come with higher risk. Each type has its own risk and reward profile. Large cap stocks are generally considered safer but may offer lower growth potential, while small cap stocks can be more volatile but offer higher growth opportunities. It's important to research and understand the companies you're investing in. Look into their business model, competitive position, and industry trends. Look for companies with a strong track record, solid financials, and growth potential. Diversifying your investments across different sectors and industries can also help manage risk and improve your chances of success. Section 6. Bonds, lending for stability. Bonds are less risky than stocks. When you buy a bond, you're essentially lending money to a government or corporation. In return, they promise to pay you back the principal amount plus interest over a specific period. Bonds offer lower returns than stocks, but they provide more stability and predictability to your portfolio. They're a good option for investors who are risk-averse or looking for income. Government bonds, in particular, are considered very safe investments. Section 7. ETFs and mutual funds, diversifying with ease. ETFs and mutual funds are like baskets of stocks or bonds. They allow you to invest in a diversified portfolio with a single purchase. This diversification helps reduce risk because your money is spread across multiple investments. ETFs are traded on stock exchanges while mutual funds are bought and sold through brokerage firms. Both ETFs and mutual funds offer a convenient and cost-effective way to diversify your portfolio and gain exposure to different asset classes. Starting small, dreaming big, investing on a budget. You don't need a lot of money to start investing. In fact, you can begin with as little as $5. Many online platforms offer fractional shares, allowing you to buy a portion of a share in expensive companies. For example, if a share of company A costs $1,000, you can buy a fraction of that share for a much lower price. This makes investing accessible to everyone, regardless of their budget. Remember, every dollar counts, and small, consistent investments can grow significantly over time. Section 9. Dollar cost averaging, a steady path to growth. Dollar cost averaging is a simple but powerful investment strategy. It involves investing a fixed amount of money at regular intervals, regardless of market conditions. By investing consistently, you buy more shares when prices are low and fewer shares when prices are high. This averages out your purchase price over time. Dollar cost averaging takes the emotion out of investing. You don't have to worry about timing the market or predicting its ups and downs. It's a disciplined approach that helps you build wealth steadily over the long term. Section 10. Patience and discipline. Avoiding FOMO in investing. Investing is a marathon, not a sprint. It's important to be patient and disciplined, especially during market fluctuations. FOMO, or the fear of missing out, can lead to impulsive investment decisions. Don't let emotions drive your investment strategy. Stick to your plan, stay focused on your long-term goals, and avoid making rash decisions based on short-term market movements. Remember, time is your ally. The market goes up and down, but over the long term it tends to go up. Section 11. Building a resilient portfolio. The power of diversification. Diversification is key to building a resilient investment portfolio. It means not putting all your eggs in one basket. By spreading your investments across different asset classes, industries, and geographies, you reduce the impact of any single investment on your overall portfolio. If one investment performs poorly, others can cushion the blow. Diversification helps you manage risk and protect your investments over time. Section 12. Never stop learning. Your journey to financial freedom. Investing is a lifelong journey of learning and growth. It's not just about putting your money into stocks or bonds. It's about understanding the market, the economy, and how different factors can impact your investments. The more you know, the better equipped you'll be to make informed investment decisions. Knowledge is power, and in the world of finance, it can be the difference between success and failure. There are countless resources available to help you expand your financial knowledge. Read books, listen to podcasts, attend webinars, and take online courses. The internet is a treasure trove of information, and you can learn from the best minds in the industry. Follow reputable financial experts and stay updated with the latest trends and strategies. Join financial communities and forums where you can discuss ideas and get advice from experienced investors. Stay curious, ask questions, and never stop learning. The financial world is constantly evolving, and staying informed will help you adapt to changes and seize new opportunities. The more you invest in your financial education, the brighter your financial future will be. Education is an investment in itself, and the returns can be substantial. Remember, Investing is not just about making money, it's about achieving your financial goals and living a fulfilling life. It's about having the freedom to do what you love and providing security for your loved ones. Start today, stay consistent, and watch your money grow. The journey to financial freedom begins with a single step, and every bit of knowledge you gain along the way will bring you closer to your goals.